Hi everyone, and thank you for tuning in. In this video, I'm going to show you all what had investors excited about Starbucks Investor Day in 2022. The stock popped higher after this presentation. It went from $80 a share to $90 a share. Before the Federal Reserve's meeting where they raised interest rates and that brought down the broader markets, Starbucks stock came back along with that. But before that, the stock had popped because of what investors saw from this meeting. So let's get into the details. This is Starbucks CFO segment of its Investor Day presentation, and the headline right up front was this target of earnings per share growth of 15 to 20% annual EPS growth. That's excellent growth from a company the size of Starbucks, right? And their business had been a little bit stagnant in the last few years, and it was devastated by the pandemic. And so forecasting growth of 15 to 20% for the next several years was great news, and that had investors excited. But it wasn't just the number that had investors excited, it was the credibility of it, the fact that this is achievable. And Starbucks went on to highlight how they're going to achieve this growth. And the building blocks of the growth, they went on to say, is comp growth, which stands for comparable store sales growth. That means stores that were already open for more than a year. Let's say they were achieving 100 million in sales, they're going to achieve more than 100 million in sales. So the existing stores are going to generate more revenue than they were in the previous year, and they're going to sustain that growth year over year. They're going to keep growing through new beverages, through add-ons and other enticements to get customers to come to the store more often. Okay, so that's one leg of the three-legged stool here. The other one is store growth. So they're going to keep adding more locations. Now you might say, well, just when I drive down the street, I see 4 Starbucks nearby. They don't really have anywhere else to add stores because they've already saturated the market. Well, that might be true in the US, but that's probably not true internationally. Now, I might agree with you. Here in Los Angeles, in my neighborhood, within walking distance, I have 4 Starbucks to my house. Within walking distance, there's 4 of them nearby. So I would agree that it's a little bit saturated here in the US, but internationally, it's got a lot more room to grow. Finally, margin improvement. It's going to improve its profit margins, and we're going to look into a few ways how it's going to improve profit margins. And of course, underlying all of that is disciplined capital allocation. It's not going to just invest in any new location. It's going to make sure the numbers add up, the economics add up, and then it's going to invest. So first, looking at comparable store sales growth between fiscal year 23-25, globally, Starbucks is expecting 7 to 9% comparable store sales growth, 7 to 9% in the US, and then in China 4 to 6%. Now this is a realistic outlook because China is still reeling from the COVID-19 pandemic. They're still implementing lockdowns in certain cities, and so they're a little, well, I should say a lot more behind in their economic reopening. And so Starbucks is incorporating that into its outlook, saying, look, it's going to take some time for them to fully reopen. And so we're expecting slower sales growth in China, but in the US 7 to 9% because we're more further along in this reopening. The next leg in its excellent outlook is store growth. And between 2023 and 25, it expects to expand 7% annually locations. That's robust growth. They've already got over 30,000 locations worldwide. 7% would be nearly 2,000 or more than 2,000 stores every year. That's pretty awesome. And so here again, we see in the US, I talked about earlier how it might be a little saturated here, and you see it here where they're only going to do 3 to 4% growth in the US and double digit 13% growth in China. That's more than 4 times the, well, I should say roughly 4 times the amount of growth in the US. It's expanding its presence in China. China is already its second largest market behind the US, and over the next few years it's going to catch up in proportionally to the US. And that's also going to help profit margins, because you may not be surprised to hear that operating a Starbucks location is less expensive in China than it is in the US. If you look at Starbucks financial statements where they break out the store level operating margins, it's much higher internationally versus the US. And so the more they expand internationally versus the US, the more they're helping expand their profit margins, because those locations individually, each one is more profitable comparable to a location in the US. So as the proportion of stores internationally catches up to that in the US, that's going to put upward pressure on profit margins overall. So combining comparable store sales growth with new store development, they expect global revenue growth to reach double digits over the next several years, 10 to 12% revenue growth. This is really, really good. Finally, margin improvement is going to work on expanding its operating income margin through the positives, and there's going to be some pushbacks. So let's look at the positives first. And the first one comes from sales leverage. When you grow sales and you have a fixed expense base like Starbucks does, you think of each of their locations needs to pay a certain amount of rent every month or a lease every month, regardless of where sales are. And so if rent is here and sales are growing, that means that difference between the sales and the rent, that's profit margin. And so as rent stays the same and sales expand, that's increasing profit margins. So that's called leverage or operating leverage, and Starbucks has a lot of that. So if it can grow sales at 10%, its costs, most of its costs are fixed, right? And so that's going to create leverage, that's going to boost profit margins. And then so it calls it reinvention benefits, and so it's making some changes in how it operates the stores to kind of get more leverage out of labor. And one of the primary ways that it's doing this is through its investments in the digital side of the business, right? If we are all ordering our Starbucks beverages through the app, that's one less person that needs to take our order, and that person can be preparing beverages instead. And so as the percentage of digital sales rises, which it has been, that's going to create more employee leverage, because now they can be preparing drinks, and the app doesn't cost Starbucks that much money. It doesn't have to pay its app an hourly rate. The app can work and take arguably an infinite amount of orders, and the personnel inside Starbucks can spend their time making the drinks, and so they can make more drinks and get more drinks out. And that's really a big way that Starbucks can boost sales, right? Because I know many of you that have visited a Starbucks have gone there and realized a long line to order, and then a long line waiting to get your drink, or you might have gone through the drive-through and waited in that long line to get your drink. If the people inside working at Starbucks do not have to take your order and they can just work on making the drinks, then they can get people the drinks faster, and that can reduce the lines and capture more sales, right? Because I know I've driven by a Starbucks with the idea that if the line is not too long, I'll go into the drive-through. But when I see that long line, I just drive by and say, but if that line was shorter, I would have went in. Or if I had confidence that that line was going to move a lot more quickly, I might stop in. So if Starbucks can improve that throughput, that output, that can be another way to capture more sales. And then they're planning on making money through supply chain savings. So they've invested in logistics and the technology data enhancements to know where to have the inventory, where sales are coming in. That's helped by the digital side of the business, and that's all going to work to improve profit margins. And then let's look at the headwinds though, because it's not all going to be positive. These investments that they're making are going to it's going to cost Starbucks money, right? They got to pay for these digital investments, enhancing the website and all of that. And so that's going to impact profit margins up front before it starts to leverage. And then finally, inflation is going to hurt margins. They had to increase wages and they raised wages for all employees. And so that's going to hurt profit margins in the near term. Despite all of that, including all of that, Starbucks still said that they were expecting earnings per share growth between 15 and 20% over the next several years. So that's what got investors really excited, and that's what caused the stock price to pop $10 from $80 to $90 per share before Chairman Jerome Powell with his interest rate increases brought the market down and Starbucks along with it. So great news for Starbucks. If you're more interested in Starbucks stock, I've got a video on answering the question if Starbucks stock is a buy right now. I'll link that above. So click on that video and I'll see you over there. Thank you for watching. I'll see you in that video. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.